why governments want inflation, and why your savings pay the price. Governments don't need to raise a single tax to take purchasing power from you. They just need time and a 2% target. No raids, no emergency laws, no dramatic speeches, just math. Because inflation isn't an accident. It's not some mysterious weather pattern that drifts through the economy. It's policy, managed, targeted, defended. And once you understand why governments consistently prefer inflation, you stop seeing rising prices as random. You start seeing them as structural. Here's the uncomfortable reality. Every government would rather deal with inflation than deflation. Not because they enjoy chaos, because they owe too much money. If you owe someone $1 trillion, you have two choices: pay it back honestly, or make $1 trillion worth less. One requires discipline. The other requires a central bank. Guess which one scales better? For decades, inflation hovered around 2 to 4% across most developed economies. It felt harmless, predictable, almost polite. You deposited money in a savings account earning 1%. Inflation ran at 3%. You technically lost 2% a year in purchasing power. But it was slow, quiet, like a leak you can't hear. Then 2021 happened. Inflation jumped. 5%, 7%, 9% in the United States. Higher in parts of Europe and emerging markets. Suddenly, the leak turned into a visible crack. Groceries jumped. Rent surged. Used cars cost more than new ones. People started doing real math instead of trusting averages. And when they did, they realized something unsettling. Their wages weren't keeping up. Their savings weren't safe. Their low-risk bonds were locking in losses. So central banks stepped forward with explanations. Supply chains, energy shocks, temporary distortions, transitory pressures. Some of that was true, but not all of it. Because inflation isn't just a side effect of crisis. It's a release valve for debt. And modern governments run on debt. Take the United States. Federal debt now sits north of $30 trillion. Annual tax revenue, roughly $4 to $5 trillion. That means the government owes the equivalent of many years of total tax collection before funding defense, healthcare, infrastructure, or anything else. Now imagine you're managing that balance sheet. You can slash spending dramatically, politically explosive. You can raise taxes aggressively, also explosive. You can default, financial suicide. Or you can allow steady inflation to erode the real value of what you owe. Inflation is the quiet option. Here's how the mechanism works. When a government borrows, it issues bonds. Investors lend money in exchange for fixed payments over time. Those payments are denominated in nominal dollars. Nominal. That word matters. If inflation runs higher than expected, the real value of those fixed payments shrinks. Let's make it simple. You lend $100,000 at 2% interest. You expect safety, predictability. If inflation averages 2%, you roughly break even in real terms. But if inflation averages 6%, you're earning 2%. Prices are rising 6%. Your real return is negative 4%. Every year, the government pays you exactly what it promised. But what it promised buys less. No law was broken. No contract violated. Yet wealth quietly shifted. Multiply that dynamic across trillions in outstanding debt and the scale becomes enormous. This isn't conspiracy. It's arithmetic. Now zoom back to 2008. The financial system cracked. Banks failed. Credit froze. The Federal Reserve stepped in with quantitative easing, creating digital money to buy bonds and stabilize markets. Trillions were added to the system over time. At first, consumer inflation stayed low. Why? Because much of that new liquidity flowed into financial assets. Stocks rose. Real estate recovered. Bond prices surged. Asset inflation exploded.
If you owned a home or equities, your balance sheet expanded. If you held cash earning near zero, you treaded water at best. The system stabilized, but inequality widened. Then came the pandemic. Governments didn't just support banks. They supported households directly. Stimulus checks, business loans, expanded benefits. Classic demand pull pressure. This time inflation didn't stay inside asset markets. It showed up at the supermarket. And that's when people felt it. Now here's the deeper layer. Inflation doesn't hit everyone equally. It rewards debtors. It rewards owners of scarce assets. It punishes holders of fixed income and cash. If you have a fixed rate mortgage at 3% and inflation runs at 6%, you're effectively repaying your loan in cheaper dollars. Meanwhile, your home's nominal value often rises with inflation. That's a powerful asymmetry. If you own equities in companies that can raise prices, revenues adjust upward with inflation. Costs rise too, but nominal earnings tend to grow over time. But if you're a retiree living off fixed payments, if you're sitting on cash savings, if your wages lag behind price increases, you absorb the adjustment. Modern monetary policy is often described as neutral. It isn't. It systematically redistributes. From savers to borrowers, from fixed income to variable income, from those far from assets to those close to them. Why would policymakers tolerate that? Because the largest borrower in the economy is good from it itself. Moderate inflation reduces the real burden of its debt without requiring a dramatic political fight. Central banks publicly frame their 2% targets as a buffer against deflation. And that's partially accurate. Deflation can freeze spending and amplify recessions. But 2%, compounded for decades, steadily erodes purchasing power. Over 10 years, 2% annual inflation reduces purchasing power by nearly 20%. Over 30 years, it cuts it roughly in half. That's not a rounding error. That's structural. Now contrast the narrative with the incentives. The narrative says inflation is carefully managed for stability. The incentive says inflation makes debt more manageable. The narrative says surprises are temporary. The incentive says a little more inflation is easier than a little more austerity. When inflation spiked after the pandemic, many policymakers insisted it would fade quickly. Some pressures did ease, but prices rarely reset downward in a sustained way. The level ratchets higher. Wages slowly catch up. Sometimes. Savings don't. The credibility of central banks rests on a delicate balance. They must generate enough inflation to support that sustainability, but not so much that people lose confidence in the currency itself. Too little inflation and debt burdens feel heavier. Too much inflation and borrowing costs spike as investors demand compensation. It's a narrow corridor, and we're walking it with historically high debt levels across most advanced economies. So here's the bigger question. If inflation is politically easier than austerity, if debt continues rising faster than growth, if aging populations increase fiscal pressure, how sustainable is a system that quietly relies on purchasing power erosion to stay afloat? At what point do savers demand higher yields? At what point do markets stop assuming inflation will always be controlled? Because once expectations shift, the math changes. Inflation works best when it's gradual, predictable, boring. The moment it becomes obvious, it stops being invisible. And invisible taxes only function as long as most people don't see them clearly. So the real issue isn't whether governments prefer inflation. It's whether they can continue managing it without losing trust. Because trust, not paper, not digits in a ledger, is what gives money value in the first place. And trust, unlike currency, can't be printed.